Hey everyone, it's Ed Kime, CEO over at Quantcha, and welcome to the September 13th, 2015 News and Updates video. It's been a long summer and we are excited to get back and show you some of the cool stuff we've been working on, and we've got plenty of neat stuff coming over the coming weeks. So let's dig right into the first thing, which are some of the new strategies that we've implemented and deployed out to the live site. The first one we'll talk about is the short iron butterfly. This is a strategy that's just like the long iron butterfly, but with the long and shorts reversed. So in effect, what you're hoping for here is that the underlying stock will move significantly in one direction or another from the focal point of your strategy. So let's give a good example here. I'm going to bring up my dashboard, and here we are with the current Quantcha dashboard page. And we're going to start off, we're going to take a look at Disney. And I picked Disney here because Disney has relatively low implied volatility really over the foreseeable future. And that's a great thing to have if you're going to employ one of these strategies, because you want to be able to buy the options that you're working with. You're going to be buying a put and buying a call, and those are the options that are going to be closest to the money most likely, and therefore the less expensive they are, the better for you as the investor in this particular case. Now we're going to go out past the earnings call here to the first options available, which is quite a bit later, but at least it's the options after the earnings call, because in a real world scenario, you might expect Disney to have some numbers, or you might expect there to be some news that comes out that will significantly move the stock one way or another. Now, of course, if you expect it to go directionally bullish or bearish, there are better trades. But in this case, let's say we'll kind of break this back to some of the defaults here. We're going to take a look. Now, this is the default range that we have plotted out here. This 6828 probability means that if you went right down the middle of where the stock would be from a flat movement, we go one implied distribution up and down to give you the kind of the default range to think about the stock where the market makers sort of expect it to land in this time frame. So we're going to do a couple things here. The first one is we're thinking there might be a bigger move. So we're actually going to stretch this out to say, oh, hey, maybe we think it could go up or down 20%. And of course, this is arbitrary. We're just saying that here. And you can kind of see from the slider what the model is for the change that's expected. And you can see there's a 92% probability. That just means that it's very likely it'll end up in this range. Of course, for the strategy we're looking at, we're hoping it doesn't end up in the middle, but rather moves out to the edges. We're also going to use midpoint pricing here. That'll give us a little bit more realistic idea of what the pricing would be like that we'd actually get, as opposed to our after hours market pricing. So we're going to apply that now. And what that'll do is that'll go through and it'll chew through all the various trade options. Now, in order to illustrate the point I want to get across here, what we're going to do is we're going to come down and we're going to locate the short iron butterfly, and we're only going to look at that strategy. And so you'll see that that filters everything down here. And immediately you can see there's a bunch of cool trades that look pretty good. Now, I'll just go with this first one that's available. And if I scroll down a bit, this is the part that's most interesting. So we'll take a look. This particular trade says we're going to sell a put at 85. We're going to buy a call at 105, we're going to buy a put at 105, and we're going to sell a call at 125. That gives you a chart that looks like this, or a more better example is this over here. This is the short put that we have. This is the long put we have. So think of this as a put spread. And then the call spread we have is over here. We're long this call and we're short this call. So we're capping our gains on these sides, but that also lowers our cost basis or our investment basis for getting into the position. Anyway, as you can see in this particular case, as soon as we break even if the stock is at or below 96.23, or if it's at or above 113.77. And again, these are the sort of moves that if you expect big movement in the stock over that period of time, this is the right kind of trade that you could go and implement. So that gives you an idea of what the short iron butterfly is about. And there's a lot of cool stuff you can take a look at here. For example, you'll see typically a profit density diagram that looks something like this, because you'll always see this big trough in the middle of loss, and then as you get further out, this is less likely than this is, obviously, on either side. But combined, these two things could make up for that if the movement does come true. So that's an example there. Now, another strategy that we put in place is we took our short put that we had before, and what it really was a secured put. We had used the term short put for a long time, but we'd always assumed that you were backing it with cash. Now, the cash back put has obviously a much different investment basis than a true short put. So we implemented a correct short put strategy that has naked puts. And the margin rules for when you're level 4, for example, what you can do with naked puts is much different than what you could do at the lower levels when you have to back your puts with your otherwise naked puts with cash. So let's pick up where we left off in Quantcha and take a look at the difference between the secured put and the short put. So we'll go back to the search results. We'll stick with Disney, just kind of keep things easy. And we're going to narrow in the results a little bit. We're going to take a look at a neutral forecast for this particular stock at that time. And let's start off with the secured put. So we got secured puts here. So you can see the secured put, the credit that you'd get for selling this 100 put is $305, but the risk you're dealing with is nearly $10,000 because what you have is $100 in collateral you got to put up for every share you sell the put on, because you have to be able to buy out those puts if the stock goes to zero, and that's just sort of the nature of options at that level. If you're below those levels, but if you get into level 4 or higher, where you can now short puts using just margin, you can see that the risk becomes significantly lower here. And now risk is the wrong word per se, but in this instance, we're using risk to refer to the amount that's owed, or the amount that you have to put up as part of your margin in order to place that trade. And this is not really a good example. Let's go down to 100. This is a more apples to apples comparison, because this is selling that 100 put. And you can see here that the margin in place, the rules are different because of the fact that you're dealing with something that's a little bit out of the money. But the point being that we now model both of those, whereas before we were just looking at what was the secured put and we were calling it the short put. So another strategy available for you to work with. Now, another thing that came up is we had lots of questions come in that we handle on a regular basis, just things about options trading where we can explain why the modeling or the analyses result the way they do. One question we actually had that was pretty interesting, we had to dig into just to confirm before the answer kind of became obvious. But the question was, someone noticed that sometimes covered strategies like the protective call, which is where you short a stock and you buy a call so you protect your downside in case the stock goes up, sometimes they can be projected to potentially lose more than 100% of the investment. And as you know, we pride ourselves at Quantcha in giving you great insight into what the risk is for a given stock. And one of the things we allow you to do is to say, don't show me trades where I would lose more than X percent. So, and our lowest is 100%. We won't show anything in the search results where you lose more than 100% as a minimum return. So that's just sort of just the nature of what we show for the given, within the views that you're looking at. Now, the reason this can come up, even within a forecast you have where it shows up in the search results as being less than 100% loss, but sometimes in the deep analysis, and the reason for that is because anytime you short stock, you're on the hook for the dividends of that stock. And so we can actually take a look at an example of that. So let's switch back over to Quantcha. And we'll pick up here and let's take a look. Disney here is a stock that has a dividend. And so this is actually a good example here. I'm going to come up to the options that are closing out next week. And in this particular case, I'm going to go to that same protective call trade. So here we can see a protective call on a neutral strategy. The idea behind this protective call is that you're short the stock and you're buying a call to protect yourself if the case the stock goes upward. Now, in this case, the pricing is a little different, but the point here is that the lowest you can go to is this 115 mark. So if you do hit 115, which is the option that's being bought here, if you do hit 115, you are maxing out the loss. In this case, the total risk you're putting on the table is that $1,053. So that's that's fine there. But let's say we went out past the dividend or the next expected dividend, or even let's say we go out to I would assume probably even just to the 9th is probably far enough. The dividends were okay, so we're looking at July 1st. So yeah, let's just say that far out. What you can see here now is that the minimum return for the same trade is a 101.54% loss. Now the reason for that is because in the event that this time goes on, if you are still short the stock when the dividend or the anticipated dividend comes out, you have to pay that dividend to the original owner of the stock, because you're basically promising them all the benefits they have as a shareholder, that you're going to fulfill those on your own. And so in this particular case, that is something to be aware of, is that you do have that greater risk. Now, it's not a risk that's guaranteed because you open this position, but if you opened this position and held it all the way through expiration, it is something you'd have to be aware of. And so that is why you can occasionally have a minimum return that's more than 100% loss, even in a covered position or a covered trade such as a protective call. So that's the only mailbag question we're going to get to today. Thanks a ton for tuning in. Hope everybody's having some great trades in this time of big volatility. If you got any other questions, please hit us up at hello@quantcha.com, and happy trading.